All right, welcome everybody to the State of the Markets halftime report. This is our semi-annual deep dive on all things markets and economy. At the top here, I want to introduce our esteemed panelists. We have Anu Gaggar from Fidelity. She's a chief or a capital market strategist at Fidelity, and also Chris McLeod, who is VP of Portfolio Consulting at Mariner. So thank you both for joining us. We really appreciate you having you here. All right, so let's click through stuff to keep the attorneys happy and into the material. So this presentation is broken up in three parts. Where we've been, where we are now, and where we're going. So first up is a little bit of a review of the first half. Chris, I'll ask you to speak to this CAT acronym. This is something that our house, internal strategists were referring to at the beginning of the year, the clear air turbulence. Can you speak to that analogy a little bit?
Yeah, definitely. The clear air turbulence is just kind of calling out the fact that, at the beginning of the year, valuations were, a little bit higher. And so we were basically expecting some turbulence along the way, right? Where we're expecting some volatility, some ups and some downs. The clear air turbulence is actually the acronym here because you kind of get to where you're going, but you do it in a fashion that's a little bit bumpy and gets you a little nervous along the way. And so it's just kind of it's really actually played out here because with the whole tariffs thing, there was a lot of nerves there in April. You can actually call it out. We've almost had it in two halves, really, from where we're at today, where we had the really nerve-wracking time, and then we've had the good times, the clear air since then. The turbulence was early. So, that's kind of what we were going for there. Um, that just kind of explains the clear air turbulence that we were calling out.
Yeah, and it was spot on. I mean, a nearly 20%, or I guess 20% if you look at intraday returns, air pocket, so to speak, there in April. And so we broke down the performance, just to kind of like call this out, from January to April 8th. You can see in the left column, where things ended up sort of at the bottom of that air pocket. And then where we've been, from April 8th, through the end of June, summed up with, the first half of the year, returns. So yeah, volatility for sure. We'll talk about this more, but it's really been a soft data problem, not a hard data problem, in terms of what we're seeing on confidence and CEO surveys and consumer surveys and things like that. But keeping a measured perspective and really focusing on fundamentals like earnings is what we think is most important now. And of course, we called this out early in the year. It was a good time to start thinking about an international allocation. And of course, that is, absolutely played out. And so, without further ado, we'll kind of jump right into that. This is the colorful scatter chart of, asset allocation versus, what parts of the market have done well over time. If you look on the far right column, the year to date, you'll see developed market equities, at 19.9 and emerging market equities at 15.6. Which had not been the bell of the proverbial ball, recently, but we're sort of poised for performance this year. And one of the key factors there is the U.S. dollar. And so, in periods where the dollar is declining versus a basket of global currencies, it's more likely that that international stocks will outperform when their earnings are converted back into dollars from their original home currency. And so we're at a point now where that has, been the case and in a pretty serious way. If we look at global equity markets, you can see in this table here, who's performed well. Germany is really at the top of the pile. Year to date local return in the local currency of 19.2, but converted to dollar 35.2, right? So, currency and changes in currency valuation make a big difference. And this slide, I think, sums it up really well. If you look back over the last 15 years, right? You see the US here sort of in the left-hand side, you can see the return, 14.9. A lot of that came from, earnings and multiple expansion, right? But if we look year to date, check out the Eurozone, right? 28.7 return, but about half of that is coming from currency, changing currency. And then about the other half, not full half, but a good chunk outside of dividends is coming from multiple expansion or people willing to pay more, for those multiples of earnings. And so before we move, away from here, Anu, Chris, thoughts on international, equities, currency, where we are in the currency cycle. Is this something we expect to continue as a tailwind for international equities?
Yeah, if I may start here, Chris. So definitely, I think currency is a big component to what's happened in international markets this year. Almost 50% of the returns for non-US equities has just come from the dollar depreciation alone. But to Sam's point, aside from that currency, there's also valuation, which is essentially a reflection of what investors think is going to come in terms of the fundamentals from non-US equities. So, I mean, the dollar or the currency is one of the drivers of returns. It's not the only one. It is an important one. But as long-term investors in equities, we do think that equities go where earnings go. And we do see an inflection higher in non-US equity earnings as well. And aside from that, the other key aspect I would point out is just the macro outlook on non-US economies. That has also started to look better, both from a monetary policy and a fiscal policy standpoint, where we tend to focus a lot on whether the Fed's going to cut rates or not, will it not? But if you want to talk about central banks outside the US, most developed market central banks outside the US, with the exception of Japan, are still in the process of cutting rates because they don't have as much of an inflation problem as we do. There's a bit more labor market slack there versus here. And those economies are also a lot more interest rate sensitive. So easier monetary policy helps them more.
I see.
They are now willing to do more fiscal spending outside the US as well. And more fiscal spending, at least in the near term, leads to more economic activity. So a lot of stars are lining up for non-US equities now, which is very different from the last almost 16 years, where it was really just a valuation story.
Right. Right. Yeah, absolutely. It's monetary policy, it's fiscal policy, it's valuations, it's currency, it's a whole mix of trends that have led to the outperformance. Chris, anything you'd add to that on the international side?
Yeah, when we did some studies, so when we looked at this time period that we had like just after COVID, right, with a um, high above average inflation, high inflationary environment, we looked at the past and very similar inflation environments. And the one that we kind of thought was closest to the COVID environment was, late 70s, early 80s. One of the trends that we saw was, hey, after that inflation hit, when it started to come down, there was a really big move in the international markets. And that was heavily currency related. So we were kind of expecting this, but we just didn't know when it was going to happen. Now it's starting to happen. And I really think this is going to be, not just one quarter, not just two quarters, but, a little bit more of a, mid to longer term cycle here. The valuations have just gone, for a really long time in the favor of the US. I think that's going to kind of get peeled back a little bit over the mid to longer term here.
Yeah, I think there's a longer tail to this trend as well, and our clients likely know because we've written about it. But we increased our international exposure materially in February. And we were able to get our rebalancing done right around April 7th, 8th, 9th, and 10th. And so all of that has worked out so far this year. Let's switch gears uh, back to the US for a moment. So, everybody talks about the Mag 7 and this concentration in the S&P 500. The market cap, this is as of the end of June. The top 10 stocks made up almost 40%, 38%, of the S&P, but for good reason. I mean, they contributed 32% of the earnings. I mean, these are the best companies in the world, just world-class companies that have been through, pandemic and inflation and tariffs and, all this stuff. And they have found a way to continue to not only preserve their earnings, but grow them significantly. So the size, or the allocation in the S&P is by and large warranted. Now, they are, fairly expensive compared to, long-term averages. But that's not, the case across the entire, S&P. So, if we look a little bit deeper, beyond the top 10, what you see here is in the red is the S&P equal weight index. So all 500 companies weighted equally. That PE ratios, or price earnings, the amount of dollars you're willing to pay for each dollar of earnings that you get back, is at 16.88. That's not too far from long-term averages, right? If you look at the S&P, like, sort of overall, let's see here. The orange one includes Tesla, which puts us at, 44. The yellow one is excluding Tesla, the Mag 7 excluding Tesla at 26, and then the S&P, the broader S&P at 22. So there are still pockets of value out there beyond the Mag 7, and lots of opportunity both domestically and internationally. And so Anu, Chris, I don't know if you guys have any feedback on valuations or sort of, where we are in Mag 7 land.
So, when I look at this chart, I'm thinking about a pond where these Max 7 are like these big fish in the pond, but then this pond is full of fish, right? So all the other companies outside of the Max 7, which now the market costs them the S&P 493, there was a good reason why they potentially did not do all this well in the last couple of years, or bulk of the returns the last couple of years was pretty much just driven by these Max 7 stocks. And the reason was that they were almost the only games in town, because they were the only ones that were growing earnings.
Mm-hmm.
And that remains the case, at least for now, but that seems to be shifting.
Mm-hmm.
So all these other smaller fishes in the pond are going to start to matter as well. So when I look at this chart, I'm like, well, the pond's full of fish. Keep fishing. Spread your baits, but keep fishing.
Yep, absolutely. Absolutely. This pond is full of fish. Chris, any feedback on your end on valuations and the rest of the market?
Yeah, it just kind of shows how difficult it is to pick the winners, right? Because you've got these premium valuations for the Mag 7, but they've really earned it. So, they are a lot of entire countries would love to have the balance sheet of an Apple or a Microsoft. So when you kind of consider that in the free cash flow, the amount of money that they're piling into, AI and these really big themes that are going on, the cloud, right? New technology, they've just kind of earned that premium. But hey, it's not the only game in town. Look at the valuations. There's some really good companies that are in the S&P 500 that are also at a much lower valuation. So it's definitely, we always preach diversification, because if you're just kind of really heavily only invested in that Mag 7, you might have some periods where, you're lagging a little bit. So it's definitely important to just, we always preach diversification.
Yeah, and we're gonna talk more, speak more to sort of where we're going in the Mag 7 and the rest of the market here a little later in the presentation. But that is where we've been, right? So let's talk about where we are now. I wanted to put this slide up just briefly because I thought it was Mariner's House call on the S&P was 6,600 by the end of this year in January of this year. And it was sort of middle of the pack in terms of expectations and where people thought the market was headed. But what I thought was neat is that, the lion's share of strategists adjusted their target significantly after the tariff, taco trade, whatever you want to call it. Mariner didn't, it's the same target. And that type of consistency, I think, is valuable when you're trying to make, decisions on clients' behalf. So I thought that sort of steady hand was a testament to our team. Um, the market has to climb a wall of worries, right? This is important for a healthy market, to do. And so, Chris, can you speak to the current wall of worries for us?
Yeah, no, definitely. We've done this, every year, and we're obviously, reevaluating these things. But if you look at all these things, these are what's actually causing, all the, air quote it here, but clear air turbulence, right? We've had the tariffs. They're getting jumped around a little bit. We've got a little bit more real numbers, hard data in there now. But when they were getting changed quite frequently, that was just a worry for us, right? We've got the war in Ukraine going on. Hey, is anybody else going to join, right? So something like that is always the worry. But, it just kind of reiterates the stay the course, right? And so, that kind of goes back to the previous slide that Sam was talking about here with just staying with our 6,600 price target. We knew there was going to be volatility. All these things are normal. They happen, right? Like, whether it might be something else. Maybe it's fiscal policy or the debt or a recession worry. These things tend to change over time, but the basics are, hey, stay invested, stay the course, because those things will eventually get better and subside. And they really have started to subside here. We've really moved from tariffs being, a worry. Now it's kind of subsided because we've gotten, some clarity there. And now, we're probably thinking, okay, well, let's really watch the inflation front. Let's watch the employment figures. And, those are the big things that we're watching right now because that's going to affect the Fed's decision to cut rates. So, really, the two biggest factors that I see in the next like 6 months to a year are employment and um and just that inflation print coming out because that's going to affect the Fed's decision.
Absolutely. Anu, what are you hanging up on your wall of worries, keeping
So,
a close eye on?
so, the way I've been thinking about this year is, markets love good news for sure, right? And markets are also okay with bad news, especially, if there is a little bit of a certainty around that bad news, because markets can price it in and move along.
Mhm.
So what markets hate is uncertainty, because when something's uncertain, when you have no numbers to put in your models, how do you price it in? And in that wall of worry for the markets this year, there were a lot of uncertainties that were thrown at it. Between tariffs on again, off again, April 2nd level of tariffs to much lower, keeping pushing them out. So there was a lot of uncertainty. The same thing with fiscal policy, war, two wars. We're still kind of in the middle of them. Fed policy, will the Fed cut or not cut? So obviously, there's been a lot of different reasons for the markets to climb that wall of worry. But if we just take a step back and think about it from a longer term perspective, right? Every generation, every decade, every year, almost there's always a fair share of crisis, right? Between market crashes, wars, recession, inflation, political upheaval, there's always negative headlines. They never stop. And yet, through it all, the long arc of the stock market, it bends upward. So, to Chris's point, the key takeaway is, stay the course because as the headlines speed up, it's that long-term discipline that becomes a differentiator, and that's where Sam steps in. Sam plays a key role in keeping all of you focused on your long-term strategy, not on the noise. So, Sam is the one who brings calm in these headlines.
Thank you, Anu. I should do my best. Yeah, finding the signal through the noise, right, and tuning out, what really is noise, and sort of that signal that we focus on, right, economic growth, employment, earnings, interest rates, and credit spreads there on the right. So, I'm going to click through a couple of these and just kind of paint a picture as we head into sort of what we expect, looking forward. But yeah, the tariffs. I mean, the initial tariffs were pretty scary, and the market reacted, fairly appropriately at that point. But the current expected tariff rate is, about roughly half of the original target. We talked about this before. The
And
soft data was
Sam, can
definitely
I jump in on that
sure.
backslide there?
Yeah, absolutely.
This this was actually exactly what Anu was calling out here, the uncertainty. So if you think about this, the market was really not expecting that really high liberation proposed tariff. And so when you see the market and just kind of really big pullback, the very quick pullback that we had, it's just because that uncertainty kind of came out and peeked his head out, and then, we started getting some true fixes in there with the number. So I think that's what really kind of created the April kind of really quick pullback. And that's why it was, really fixed very quickly because, they started coming out with trade deals and, kind of pushed on the brakes there. So the market gave a little bit of some time to just kind of start pricing things in.
Yeah, it's hard to price. Uncertainty is difficult to price, right? Like bad news, you can price, right? Like to the point earlier, right? Uncertainty is very difficult to price. So no, that's a great point. So, the soft data, right, has looked shaky, right? And what we're looking at here is consumer conference index, the CEO confidence, and then small business optimism. These are also, surveys, and surveys are not, in my opinion, great data. But if you look at the hard data, it's still fairly resilient. The consumer is still spending, despite weak confidence. I think we're seeing, very much a K-shaped economy where, we're starting to see spending, pulling back in sort of lower income, deciles. But, the higher income, higher net worth deciles are still, spending significantly. ISM is sort of right in the middle there, right? Anything above 50 is positive, below 50 is negative, at 49. And then earnings. I mean, at the end of the day, like what is the stock market? It's a prediction machine about earnings, right? Future expectations surrounding earnings. And earnings still look strong. And that's what's reflected in the market today and what has been, following a lot of the uncertainty sort of washing out. So I want to, paint a little bit, more of a picture of sort of where we are from an economic perspective. Uh, you know, GDP growth was really wonky in Q1, and it was this combination of net exports. The 24-year average net exports contribution historically has been about negative 0.1%. It was negative 4.6 in Q1, right? The other huge outlier is typically right your change in private inventories doesn't have a significant impact. Well, it's 2.6 percent in Q1. So there's just a lot of weird behavior and activity going on surrounding, tariffs and sort of, what we thought was going to happen. But, ultimately the consumer, the US consumer is historically what has driven GDP growth, right? I mean, it's almost 70% of, GDP comes from consumption and, so goes the US consumer, so goes the US economy. The U.S. consumer still looks strong, is still spending. The one kind of outlier on this chart is if you look at, delinquencies on loans, you can see student loans had very low delinquencies like following the pandemic, and they just popped up. Oh no, but wait, right? They popped up to the long-term trend, right? It's not like they popped up way above it. Um, so, we don't see a ton of cracks in the consumer at this point. They still look strong, which is indicative of, the economy, continuing to stay strong. I think the caveat that you would make to that statement is we'll keep an eye on employment, right? Consumers haven't changed their behavior yet, but what would change a consumer's behavior is losing their job, right? If we look a little bit forward, and by all means, guys, if feel free to chime in as I'm moving through some of these. But inflation is it's coming down across pretty much all segments. I mean, what we still see high is shelter, right, which we know operates on a lag, but it's directionally coming down. Auto insurance, right, which I'm sure we all have felt, and then dining, right? They're still fairly elevated, but our May 2025 print came in at 2.4, which is not far off from the Fed's 2% target, right? I mean, we're making our way down. That said, the tariffs, like in of themselves, are inflationary, and I think there's an academic debate around whether it's a one-time shot to inflation or if there's like a follow-on effect, that's included there. But Chris and Anu, just briefly on the inflation piece, any sort of thoughts or things you'd want to share?
Yeah, on the inflation piece, Sam, I do certainly, our household certainly feels that auto insurance inflation. We just had two teen daughters join get added to our auto insurance.
Sorry to hear it.
We most certainly feeling it, but I will definitely say that inflation at 3% is not the same as inflation at 9%, which is where it was back in 2022. So a bulk of that disinflation journey has been traversed, went up the mountain, coming down the mountain. But as you can see in this chart, it seems like this mountain is forming a base at a level that is higher than where it was pre-COVID.
Mm-hmm.
So higher than that 2%, which happens to be the Fed's target as well. Now, with tariffs, we definitely not at those April 2nd level of tariffs. Those effective tariff rates are much lower at this point. But even with those lower tariff rates, only about a third of the tariffs have actually to flow into the economy,
Right.
which means 2/3 are still to come, which means they could potentially lead to more inflation in the future.
Yeah.
The debate now is whether that tariff is just transitory, which is what the consensus expectation is, or if it gets stretched out a little bit more just because all those tariffs don't take into effect all on the same day. So the Fed is definitely walking a tightrope where inflation is not back at their levels, but at the same time, the labor market, it is cooling, but it is not quite cracked yet. So the economy doesn't necessarily need support from the Fed. It's not on crutches anymore, which is kind of where it was back, during COVID. So it doesn't necessarily need the Fed's support anymore, which really makes it a very interesting conversation around what is the Fed going to do for the rest of the year.
Yeah, that's a good segue into that next slide. And right, the Fed has this dual mandate of full employment and managing inflation, and they are very much sort of a rock and a hard place. And then there's all the pressure from the administration certainly makes it even harder. And I think there's good arguments on both sides. But what we're looking at currently is the expectation for the federal funds rate, which, for the uninitiated, right, this is the rate that banks borrow from one another on an overnight basis, which, is really a short-term rate, but flows through to the rest of the economy that the Federal Reserve Open Market Committee sets. You can see that the FOMC, the Federal Reserve, they've got their estimates are, sort of at the end of 2025. We're at, 3.9 down from 4.38 today. The market is expecting more, right? 3.6. And then heading into 2026, the market's expecting federal funds rate at around 3, with the FOMC at about 3.6. And it's it'll be interesting to see what type of turnover we see at the Federal Open Market Committee. We know this week is sort of the swan song for Jerome Powell, if you will. He's going to give his big speech and I think attempt to cement his legacy. But there is expected turnover in those Fed governor seats, and ultimately that can have an impact on direction where we go. But down from here ostensibly, right? Unless we have some really, really surprising inflation numbers that come out. And so just kind of summing, this up, we mark, positive, neutral, and negative across all these different factors. So the fundamentals, economic trends, real rates, M&A and IPO activity, fairly neutral, but neutral to positive on, earnings trends, Fed policy, or expected Fed policy, the trend of interest rates as a result of that policy, and credit spreads, right? Nothing in the negative, at this point. Valuations, yeah, some parts are expensive, but not all. Dividend yield versus interest rates are neutral, and some of the other, valuation metrics that we look at. And then the technicals, advanced decline line, stocks above their moving averages, sentiment certainly positive. We're seeing if it's not a sort of green light, if you will, it's, yellowy green at this point. So speaking of, red lights and green lights, where are we going from here? And so what we've got here, this is our house view. This is Mariner's, base case mid-year 2025. The base case, again, 6,600 on the S&P, right? So that's about a 6% price return at the time this was published, total return of 8%. And then thinking about the economic environment, real GDP growth between 1.5 and 2%, federal funds, between 3.75 and 4.25. The 10-year Treasury at a range between 3.5 and 5, averaging out around 4.5%. And then S&P growth, earnings growth of 9% this year, but increasing to, between 12 and 15 for the following year, which of course earnings expectations are a huge factor in what the market is up to. What I like about this breakdown is it's a very sort of easy to understand, or maybe easy if you're a market observer, you're into this kind of thing. But they take an optimistic, a base, a disappointing, and a pessimistic case and say, okay, what's the multiple that people will pay for stocks, right? Optimistic is 22, pessimistic is 18, and then we've got our earnings, consensus earnings estimate of 317. A disappointing earnings of 300, and then really pessimistic of 280, and that'll give you a price target, right? It's not rocket science, which I think is cool and very transparent. Chris, any thoughts on the mid-year base case that you want to share?
Yeah, no, when I really dummy things down here, if we get positive GDP numbers, you're going to get higher earnings and the stock market will continue to grow. I know that sentiment, Anu called it out, right? Sentiment is really difficult when you're paying higher inflation and prices you've got insurance going up. So it feels like, you know, maybe the market's ahead of itself. But when you look behind the scenes on the actual data, realistically, the data's coming in really nicely. It's just that inflation is just kind of, and it's really the cumulative inflation because this has been going on for quite some time here. So it's that cumulative effect that's really been kind of making us all feel like, we might not be doing as good as we think we're doing. But when you look behind the scenes, everything's kind of moving forward, keeps on trucking, right? And, that's really important to kind of remember to, just take a step back and just kind of let it do its thing. Let the market do its thing with staying the course, right?
Yeah, GDP growth, feeding in, to earnings ultimately, and then expectations and earnings and multiples. Exactly. Like the fundamental backdrop is strong, and I think a lot of people will look at the returns that we've seen, since 2022 and say, wow, this is hard hard to believe, but bull markets are long and bear markets are short. Average bear market is about 14 months, 38% trough. Bull markets on average are about 70 months, about 221% on average return. And we're the green line, right? So we're, right here in the middle, which, I think that ultimately, so long as the fundamentals stay positive, there's more room in the run that we're currently seeing. Now, we would be remiss not to, talk about artificial intelligence and the spend that's occurring right now. What you're seeing on the slide here on the left is the hyperscalers, so Alphabet, Amazon, Meta, Microsoft. They're spending right on all of the AI infrastructure that's happening right now. The expectation, it's already high, right? It's already 60%. Of operating cash flow. The expectation is that it goes way up from here, right? And not just this year, but even after this year. On the right-hand side, you see businesses using AI to produce goods and services, right? And so right now, the total, as of June of 2025, it was only about 9%. Within the next 6 months, the expectation rising across all, sort of all different parts of the economy. But there's very much this, groundwork, being laid for an expectation of productivity that feeds through across all industries, right? And we're at that sort of early stage. I brought up a slide from the first State of the Markets earlier this year that I thought was kind of interesting just to revisit. We had Tom Galgano from Vanguard on, and he walked us through this, their house take on, what AI is ultimately, going to do in terms of GDP growth. The status quo, right, or 10 to 20% probability is what they'd applied to it, is about 2%, GDP sort of just kind of continues. We don't get a lot of growth, just kind of continues and sort of muddles along. Their pessimistic case, right, which is AI fails, right, and the deficit spending that we've got, not due entirely by the one big beautiful bill, which we just did a webinar on, but by years and years of that stacking up, is that we end up with below GDP, historic GDP growth at 1%, and they're not assigning a insignificant probability to it, 30 to 40%, but their sort of best bet, if you will, is that AI is transformational, right, and productivity ultimately surges as a result. Which would take us from a long-term trend of about 2% GDP growth to 3.1, which doesn't seem like a lot, but it is. And if that feeds through in terms of earnings and wealth and everything else, transformational is probably the right word for it. And this is the promise, right? I mean, the long-term drivers of GDP growth are growth in workers and growth in real output per worker, right? The growth in workers is a challenge. I mean, we have a demographic issue in the country, as everyone knows. And right now we have a immigration issue. Well, we've had immigration issues for a long time, but we don't have a solid, productive immigration policy, which is necessary for GDP growth. And so you need both things. You need growth in workers and you need growth in real output, in workers. And the latter, that is the promise of AI, right? Is that we ultimately get more output, more productivity, per worker in the economy. With absent, the former or, concrete policy around growth in workers, you are effectively betting the farm, that's the case. So let's get into the Mag 7 a little bit, and the rest of the S&P sort of looking forward. I think what I would draw, people's attention to is the chart in the upper right-hand side, which is earnings growth. You would look at the Mag 7 and say, wow, earnings growth is super high, right? And it has been, probably will continue to be, right? But the market is an expectations machine, right? It's all about forward-looking expectations. And if you look at the S&P X Mag 7, right, 2024 expectations, 4% growth, 7% in 25, 13% in 26, right? That is what the market prices, right? If you look at Mag 7, 40, 16, 15. Again, still very strong, very compelling earnings growth, but directionally, right, not the right way. And directional earnings will ultimately show up in prices. And so, as we talk about the rest of the S&P and other fish in the pond and value and small caps and mid caps, this is that story, right? Where the expectations and the directional growth of earnings for the rest of the market seems highly positive. So, Anu, Chris, any feedback, big picture on, sort of, whether it's Mag 7 or earnings for the rest of the market or, AI in general?
Yeah, so Max 7, this is really this chart here is the picture of the Max 7 being like the best houses in the neighborhood. Obviously, you're paying a premium for those best houses in the neighborhood. And the rest of the market, there's a lot of flip properties there, right? So if you are willing to put in the work and if you have the vision, you could make some decent returns out of those. But of course, it could also be that there are some of those properties that are value traps, right? They are cheap for a reason. They require this tremendous amount of work.
Mm-hmm.
So the point being the Max 7, obviously they are really, some of them are really amazing companies. As Chris pointed out earlier, the economy, if the economy could have the balance sheets of these Max 7, we'd all be like very happy here. But you're paying a price for that.
Yeah.
Nothing comes, no free lunches here. And the rest of the market, there are some really great opportunities there, and you're getting them at some good prices as well.
Yeah, this is where I think, bottom up security analysis really has an opportunity, to outperform because of this trend. Chris, anything you'd add to that?
Yeah, and actually, just what we were calling out with AI, I think in the future, those 2026 returns there or earnings growth are going to be really driven from the companies that can utilize AI the most, right? And, when we first came out with the internet, right? Companies like Google didn't even exist. Amazon didn't exist. There's probably, this is actually forward looking even further than 2026, but if we fast forward, 5 to 10 years down the line, there's probably going to be new companies that are in that Mag 7, that we didn't even know about. They didn't exist, right? So that's where, I'm thinking the AI trend is going to create just new companies and new winners. That doesn't mean that the Magnificent Seven can't also do very well. But if you're paying that premium price, you just have to kind of be careful with that, right?
And
Yeah.
if I may just add there, just continuing on that AI story, and yeah, indeed, the Max 7, or at least most of those Max 7, are those current primary beneficiaries of the AI trend. They are the hyperscalers. They have those capex, those cash flows to do all that tremendous amount of capex. But again, if you think about history and when there's a gold rush, there's two ways to benefit from it, right? You can either invest in those gold mines or you can invest in the picks and shovel type of companies that would be essential for those gold miners, right? So those most advanced AI systems, they need server farms filled with thousands of high power processors. They need industrial cooling systems. They need backup power supplies. So those companies that are in that part of the food chain, they're the picks and shovels. So the point being here, AI is a mega trend, just like the internet was, but there are a lot of beneficiaries out of any mega trend, which may be the second derivative, second order effect, but sometimes those mega trends lead to leaders that are not the pioneers.
Yep. Yeah, and you nail on the head, both of you guys. I mean, I think it's time to start thinking about those secondary and tertiary, beneficiaries of all this spend. Now, that's not to say that the current sort of winners are destined to lose tomorrow, right? And like what we've got on the screen here is this very similar sort of S&P march between now and in the 1990s. what I would say is, Cisco, right, was a big part of this, back then, right, laying all the groundwork, and we know what happened to that stock following the dot-com bubble. Um, but the real beneficiaries were like Meta and Google and Amazon and so on and so forth. And there will be companies just like that, that come out of all this AI spend. And so it's time to be thoughtful about what the secondary, if it's energy, generation or energy transmission or energy storage, right? And the tertiary, which are, what are the businesses that'll even if as far as we get is like very clever agentic AI, that's going to impact a lot of businesses in a very positive way, and from a profitability perspective. The other thing I'll mention is, past is not, prologue, right? And history, doesn't always repeat itself. It often rhymes. But if you look at these two charts, what I see is, yes, they're lining up fairly close. But if you were to say, okay, this scares me, I don't want to be, I don't want to get dot-com bubbled. Leaving at this point is like leaving in the third quarter of the Super Bowl because you want to, beat the traffic, right? You're at the big game, you want to, you want to be in it, but you want to stay diversified. You want to be cognizant of where valuations are, right? And you want to be thoughtful about, what the next leg might look like. Um, and so thinking of that, right, we've mentioned this before, but, value versus growth. I mean, value, stocks look, compelling in terms of valuations. The long-term average is about a 30% discount to growth. We're at 41% today. They typically also, give you a dividend. But again, like in the right-hand corner, we're looking at, growth versus value, and growth earnings, right, are still very strong, right? Like, between 14 and 18% annualized from 23 looking forward. But directionally, where are values earnings going, right? For -4 to 2 to 5 to 3, right? That's the prediction and sort of forward-looking component of portfolio construction, and balancing growth versus value, that I think, investors probably have not paid enough attention to in the past, decade plus. But value looks attractive, and if you're worried about like an Icarus and Daedalus, situation with Nvidia and Broadcom and some of these other names, having companies that simply aren't as richly priced, with more potential earnings growth is probably a wise thing to consider. Small and mid caps, underperformed. We've seen some growth in small caps, particularly small cap growth this year. But it's a portion of your portfolio that you shouldn't be overlooking as well. Before I move on, actually, Chris and Anu, any thoughts, feedback on small caps, mid caps, or value versus growth?
Well, just what I'm thinking is that value slide really kind of hits home for me because, if you see value creeping up like that and it's priced at lower multiples, you know, if you don't invest in value and you just go 100% to growth, you might miss out on when they do that flip flop, right? So this reminds me very much like 2020. I think it was 2022 when growth kind of took a hit and value finally saw its day. So it's so hard to time the market and say, oh, you know what? This is the year that value is going to have. So let me invest now and let me, underweight growth. Well, you don't have to do that, right? Because timing the market is just so difficult. So, this kind of goes with staying the course, right? If you're invested in both, you're going to profit when it does have its day, and you're not going to see the big downturns because you're invested in both. You're well balanced, and you can take advantage of the trends that are just kind of happening, when they happen.
Yeah, there's a multiplier effect to expectations when earnings are rising, and then also the multiple people are willing to pay for those earnings, right? And they get expressed in price. It's a powerful combination, and this like kind of speaks to it too. Like earnings, the growth is expected to remain strong, right? But sort of plateauing if you look at the S&P as a whole, and that's because such a large, contributor to the S&P's earnings is that top 10 group, right? If you look beyond that top 10 group, but earnings look strong and not plateauing. They look like they're rising, right? And so, staying diversified and not just kind of following what's done well recently, I think is a, important key takeaway. Let's get into international. And so, of course, the belle of the ball this year, the premium versus the U.S. And I'll point you to the right hand side of this slide. The 20-year average discount, should be about 18%, right? We're still at 35 even after the run we've seen. I mean, this was, I'm thinking back to guide to the market slides that I've used in the past couple of years, and we were like 3 standard deviations away from historical norms in terms of valuation. And so, we've had some return in international, no doubt. But there's that theme is still in play. It's not just currency. The valuations are very attractive. And if we look at, expectations around earnings, if you see on the left-hand side, earnings growth, India up and to the right, right? Japan's starting to tip down. The Eurozone's earnings have not been super strong, but we're seeing a huge change in both the monetary and fiscal policy there. And then, of course, China towards the bottom. But yeah, the 2025 and 2026 earnings growth expectations, it's in the US, 9 to 14, right? India, 12 to 15, fairly similar, but the Eurozone, 5 to 11, China, 3 to 12, right? Japan, 3 to 9. So I think that again, expectations and sort of skating to where the puck is going, it's not just currency, it's earnings and earnings growth. And then, briefly, some of the themes that, have really, if you want to go deeper, not just look at international as the broader developed markets, but what are some of the themes that have been working? European aerospace and defense, and Anu was speaking to this earlier, the monetary and fiscal policy, like particularly coming out of the Eurozone as a response to the war in Ukraine, has just, absolutely jettisoned these European aerospace and defense companies. We looked at Germany as that poster child earlier in the presentation with, I think, their German currency return at 19 translated to US at, close to 40. Those trends are occurring, and that's not something that just sort of turns on a dime overnight. That investment sort of takes a long time. But international developed market banks, with rates coming down, of course, Taiwan technology, Indian consumer discretionary, and then the laggard there is European luxury goods, which I think is probably, more related to inflation, and just, how painful things have been for, the sort of the lion's share of the population. Although there's certainly a portion of the population that's buying European luxury goods, and I don't think that, that group will be stopping anytime soon. But just, Anu and Chris, thoughts on global, equities and where we are in the cycle.
Yeah, so I would say there is a reason why the US has been doing so well, and why investors generally pay a premium for US equities, and it really boils down to earnings, right? So US companies, the US index for the most part has the most amount of innovative companies, the most number of companies that have higher operating leverage, right? So these are companies that generally tend to grow earnings stronger. And then to Sam's point, that there's strong earnings, investors are willing to pay a premium for that. Now that's not changing. So US companies are going to continue to grow earnings at a very fast clip, and likely faster than most of the rest of the world as well. But having said that, the prices of equities outside the US have been very, very suppressed, or the valuations have been very, very suppressed. So just in terms of relative to their own histories for how much of a discount they were selling for, that it is at a very steep discount. So what we are saying is that these companies don't have to necessarily grow earnings at the same pace, and they don't have to be valued at the same level as US companies. But if they just go back to that their historical average level of cheapness, that in itself gives investors a lot of runway to generate returns outside the US.
Yeah.
Yeah.
Yeah. Oh, I'm sorry. I would just have to agree with you 100%. And this shows the importance of, staying balanced and, kind of staying the course, right? When you think about an asset allocation, you know, you don't have to have, you don't have to make a call. Um, hey, let's go 100% international. US companies are still doing well, so staying balanced. But, a lot of people have been so underweight international. I think the main thing that we're just all kind of calling out here is, hey, let's kind of prop that up a little bit because it's been so underappreciated for so long. There's some really nice catalyst over there. So let's make sure that we're thinking about international as well and not forgetting about it, right?
Yeah. Yeah. It's not meant to be a replacement for US equities, but we'll talk about this in a moment, but your allocation is likely shifted if you haven't rebalanced and you were probably underweight international at a point, where you shouldn't be. So, thinking about moving on from equities, fixed income, what we're looking at here is the, expected return, and this is Barclay Bloomberg US Aggregate Total Bond Index at 4.56%. If inflation is at, call it 2.5, you've got inflation plus 2 in your fixed income allocation. I mean, we spent since '08 essentially, with that not being the case in terms of real returns, right? And so like fixed income should not be overlooked as part of your broader investment portfolio now. And of course, in 2022, we had interest rates rise and fixed income did bad double digits, equities did bad double digits. But, looking forward, if you want that safe part of the portfolio that's going to, sort of reliably produce, that 4 to 5 yield, you don't have to take a lot of risk. And from a financial planning perspective, when we make, assumptions around returns, makes my job a lot easier if I can, know that we're going to clip a 4% return or, somewhere north or south of that on this, quote unquote, safer, less volatile, portion of the portfolio. The other thing is interest rates, right? When interest rates rise, right, bond prices fall and vice versa. And so if we start to see interest rates fall, you get a tailwind on your fixed income. And, 10-year US Treasury as an example, interest rates, do nothing. You're at 4.2 percent return. If they rise by 1%, you're at negative 3.8. But if they fall by 1, you're at 12.3. That's double digit return in your fixed income on a 10-year US Treasuries. It shouldn't be overlooked as well. And then thinking a little bit about alternatives, we talked about 2022 and bonds falling, stocks falling at the same time. That when inflation is high, right, and markets are puking, correlations tend to go to 1. And that's a problem, especially if you're taking distributions from the portfolio. And so, there are other, places to look. Infrastructure, transport, real estate has been overlooked for so long. But the reason I actually wanted to include this slide was because of private equity and venture capital. For everybody on the call, mark my words, you are going to start to see little private equity sleeves pop up in your 401ks here in the not too distant future. Trump just signed an executive order to try to make that, happen. And there's been pressure, for that to happen for some time because the sort of pool of institutional buyers that soaked up all the private equity and venture capital money is pretty much tapped out. They haven't, returned that capital by and large, and they're not adding more to that allocation. So of course they're coming to wealth management, to our 401ks. But you may be getting a diversifier. You're probably not getting correlation reduction, at 80 basis points of correlation to a 60/40. So, historically they're expensive. Just be wary of the private equity that you see in your 401k. We talked about this too, the 60/40 drift. If you had not rebalanced, going back to, since 2019, you would have, 10% international, your US growth would be 37%, right? Your value would be at 27, your fixed income would be at 27, your US value would be at 26. This is why rebalancing is so important. This is why we hit the off-cycle rebalance button so hard on April, 7th, 8th, 9th, and 10th. Um, and then, final couple of slides here because we're getting short on time. You may look at the market and say, geez, how do I buy at all-time highs? Well, historically, doing so, results in, pretty good returns if you have a long enough time horizon. If over a 5-year window going back to 1988, if you invest on any given day, right, your average cumulative S&P return was 74.7, and investing at all-time highs would have engendered an 80.9% return. And so that's true, sort of if you look out longer than, sort of, 6 months or a year. So what I would say around this is that momentum begets momentum, right? There's a reason we're hitting all-time highs. It is an expectation machine, right? And so, you shouldn't be too wary of all-time highs. And stay invested, stay diversified. Time is the best predictor of results in the markets, right? So if we can align our portfolio based on time, not based on, sort of the theme of the day or a nascent sort of nebulous, risk tolerance, sort of variable, time is our best predictor, right? And so the portfolio should reflect that. I think I'll end here. Our key takeaways, avoid the whiplash, right? Like, don't change your price target because the market fell necessarily, right? You should have done the work. There's going to be turbulence, right? There's going to be air pockets. From an equity allocation perspective, maintain that long-term, stock allocation, hold your ground. We want to be considering, small cap and mid cap and value in conjunction with growth. Be aware of those imbalances, right? It's likely your domestic allocation has grown beyond its skis. It's likely your Mag 7 allocation has grown beyond its skis. So, continuing to rebalance and be aware of that, balance growth and value, and then consider alternatives on the correlation side. And so, I'll end with our, if anybody puts any questions in the chat, I don't see any right now, but Anu and Chris, any final thoughts before we close out for today?
Yeah, Sam. So I will totally wholeheartedly agree. All these air pockets, volatility, turbulence, whatever phrase you want to use, those are all the price of admission. So I think the key message is there's no reward without the risk. Market drops or turbulence, these are not the bugs, these are the features of the market. But these temporary declines are the entry fee for long-term gains. So if you want that reward, you have to endure the ride. So really stay the course and stay calm through these negative headlines.
Love it. Chris, anything you'd add? Final thoughts?
Yeah, no, I completely agree with you guys. What you're saying here, just stay the course. The price of admission. I know it's been kind of a rough year as far as April, but that's why you have Sam here to kind of guide you through those tougher times. Sometimes it's even better to just, take a day away. Don't look at the headlines because they're gonna steer you in the wrong direction. Just be calm and just stay the course. Take a longer term look at things.
Absolutely. Well, Chris and Anu, I will take this opportunity to thank you very much for joining us today. We really, really appreciate you guys being here. I think I do have one question pop up. Let's see here. Do you fear that revisions made on employment from August 1st could evolve into a bigger problem? Is this something investors should be monitoring through the end of 2025? So a revision to the employment stats, would it be a bigger problem? I think it would probably lead to rate cuts faster. It's employment is huge. I mean, so goes the U.S. consumer, so goes the U.S. economy, right? And like employment and losing jobs is the one thing that'll change, consumer behavior, like no doubt about it. So yes, I think we should absolutely be keeping a closer eye on it. That said, I think we'll get a monetary policy response that'll be positive for asset prices, at least in the near term. So, it really depends not on the one revision, but I'd say the direction of employment data, that hard data, over a slightly longer period of time. Chris, I don't know if you guys have any thoughts on that.
Yeah, so we are definitely monitoring employment, and employment's actually a lagging indicator. So sometimes that's the last shoe to drop. But, I kind of want to reiterate two things. Right now, employment is so strong. We've actually got a little bit of, you know, room on the leash here, you know, and just as Sam kind of called it out, the Fed, we really haven't had rates this high in a long time. And one thing that does do is it gives us a little bit of room where we can cut rates if things are, starting to get worse, right? So, you know, to summarize, one thing, we have the tools to combat if unemployment does start to rise. And number two, we do have a little bit of room to run here on employment. So just kind of make sure you're watching for those things.
Thank you, Chris. Anu, any feedback on that question?
Yeah, so I would just add here, just reiterating the same message. We will definitely be watching the labor market employment because that feeds into, so much of the economy. But where we are right now is that the labor market was piping hot and it is cooling down into a better balance versus cracking and showing large crevices.
Yeah.
So to that extent, it is something that we will be watching closely, but it is not something that is keeping us up at night just yet.
Yeah, one data point does not a trend make, necessarily, right? So, we have to keep a very close eye on it. But okay, well, I will again thank you, Anu, Chris. Really appreciate you guys' help today. Thank you very much for joining us. And to all the clients, if you have any questions, please reach out to me. I'll take this opportunity to thank you for your business and more importantly, your trust. And we will see you next time on our next presentation. Thank you all.